Good morning, Wall Street. Well, in this video, we're going to talk about why we look at short interest by using the short interest ratio. Now, to illustrate the importance of this, let's consider a drop of water. A drop of water, in and of itself, may not seem very consequential. But if a drop of water should fall on your head and you're an ant, that could seriously ruin your day. At the very least, you'd be a bit ticked off, like this little fella here. But if you're a big guy like me, a drop of water is simply a drop in the bucket. The size of the drop of water hasn't changed, but the relative impact, depending on your environment and who you are, can make a big difference. This kind of way of looking at the relative impact of something has great meaning when we're looking at short interest statistics. Now here's a chart of Bank of America. And this gray area is the shares short in the stock. The absolute level of short interest with just the report of a couple of days ago hit the highest level we've seen in years. So does that mean that the short selling squeeze pressure is greater now than it has been in the past? Well, the answer is no, and there's a really good reason for that. This level of short interest is a drop in the bucket compared to even this level of short interest and even this level of short interest. Now, why is that? Well, now we've superimposed upon this chart of short interest the actual volume of the shares that trade in Bank of America. Now, short interest is essentially a subset of volume. We look at the number of shares short, and we're also looking at the total number of shares here. The total volume, the total number of shares on each trading day is shown in this magenta color here. What we have here is a picture of volume that has grown almost exponentially over the last year or so. If you look at the trading activity down here, it pales in comparison to what happened in the middle part of 2008. And especially in the trading activity of this year, you can just see that volume has ballooned to extraordinarily high levels. And so the key to looking at short interest is not looking at its absolute value. That in and of itself is relatively meaningless. What you want to do is you want to look at short interest relative to what the impact would be if all that short interest were instantly covered. And that impact is a function of the liquidity of the stocks trading. So let's consider this massive amount of short interest here that we're seeing currently. If that were the level back here at point A, let's call it point A, that would be huge, because the market back here at point A is incredibly illiquid. If this level of short interest were to cover instantaneously, there'd be a huge price boost because there aren't the sellers to absorb the buying of that short covering. When you cover a short sale, when you close out your short position, you have to buy back the stock because you borrowed it earlier betting that the stock price would go down. So the act of getting out of your short sales position is a closing position, but it's closed by buying back stock. If this number of shares that are short were to hit this market with buy orders, the price of the stock would go up in a huge way because the market is relatively illiquid. The average daily volume, the trading activity isn't liquid enough, isn't large enough to absorb what is a relatively huge buy order. And that's where the essence of a squeeze comes into play. When you have a large body of traders that, should they decide en masse to get out of their position, are faced with a market that's not able to handle that kind of order. And therein lies an opportunity. And looking at point B here, we have, again, a situation where the trading activity is still relatively illiquid, maybe not perhaps as illiquid as we have in point A, but I think you're beginning to see my point. The relative ability of the trading activity to handle a large order is what we want to see. What we're trying to measure when we're looking for a squeeze play is how able is a market to handle a huge buy order from short sellers that are running for cover. But in the current situation, let's label that C, we see that the market is infinitely more able to handle an order such as this should this level of short sales instantly run for cover and buy back the stock that they had borrowed. So this is a much more liquid situation for that kind of order. And that's where we run into the problem of simply looking at short interest on an absolute basis. You have to relate it to the trading activity that's currently underway. We do this by using the short interest ratio. The short interest ratio is short interest divided by volume. Typically, the volume that's used in the denominator of that ratio is average daily volume, which for the purposes of the short interest ratio that we see here, it represents the time frame of the most recent report of short interest from the exchanges, which now is 2 weeks. So typically that would be a 2-week average. Now, that presents a certain set of problems because we want to see the ratio move up and down to reflect the changes in relative short interest that's out there, normalized, of course, for volume. What we don't want to see the ratio do is moving up and down based upon little localized Himalaya-type shifts in the trading activity. So what we do is we actually use a 12-month moving average of average daily volume. And so what we do in our work is we have this sort of slow, smooth curve up as the denominator for the short interest ratio. We see a true measure of the change in the liquidity environment for handling the covering of short interest should all the short interest decide en masse to cover at once. And what we get here is a picture of the short squeeze potential based upon this relationship between short interest and the overall trading activity. And the picture is quite clear. If you were just looking at the short interest, you'd think that this was a huge short squeeze potential here. But in fact, it's one of the lowest that we've seen in years. And that's because the trading activity for this stock is incredibly liquid, which means that should all this short interest cover, it's more of a drop in the bucket. So here the trading environment is more like an ant farm, and here it's more like a drop in the bucket. And this becomes clear when you look at the ratio, the short interest ratio. Even though this level of short interest is lower than this level of short interest, you have a completely different picture in terms of the impact of shorts running for cover might have on the price of the stock. This level of short interest back here, let's just move this chart back a little bit. The squeeze potential is even greater here because even though the absolute level of short interest is a lot lower, the trading activity is even more proportionately lower. And that means that you have a greater impact on the market, the price environment for the stock, potential for a price boosting squeeze should this short interest cover. Another name for the short interest ratio is in days to cover. So back here in the middle part of 2008, it would take over 3 days of trading activity to cover all of this short interest. Whereas today, it would take less than 1 day, 0.82 days of trading activity to cover all of this short interest. And that's why we look at the short interest ratio. Hope that helps. See you next time.